Have you ever stopped to ask, where does money actually come from? Most people think it comes from taxes, or from rich people investing. But in reality, money comes from two main sources: governments and commercial banks. Let's explore how it works and bust some popular myths along the way. First up, commercial banks create money when they lend. When you take out a mortgage or a personal loan, the bank doesn't move money from someone else's account into yours. It simply creates a new deposit in your name. In that moment, new money enters the economy. This isn't economic conspiracy. It was confirmed by the Bank of England itself in its 2014 quarterly bulletin titled Money Creation in the Modern Economy. The bank stated clearly, the majority of money in the modern economy is created by commercial banks making loans. That fact was quietly released and largely ignored by economists and commentators. And when you repay your loan, that money is destroyed. It disappears from the economy. Money is created when banks lend and removed when debts are paid down. This directly contradicts what many economics textbooks still teach. Their loanable funds models claim that banks just move existing money around. But in reality, they are licensed money creators. But commercial banks aren't the only ones who create money. Governments do too. Just to be clear, we are talking about those that issue their own currency, like the UK. Here's how. Similar to bank lending, the government creates new money every time it spends. So if the government makes a payment to you, it credits your bank account, but it also credits your bank's reserve account, which is an account your bank holds at the Bank of England. Reserves are government money that banks use to transact with each other and the Bank of England. Only the Bank of England can create and remove them from circulation. They are an integral part of the payment system. That's how new money enters the system through government spending. Now, what happens when you pay taxes? Most people think taxes are stored up and then spent later. But operationally, that's not what happens. When you pay tax, the Bank of England removes reserves from the banking system. That money is effectively deleted, so taxation doesn't fund spending in the technical sense. Instead, it's a tool for shaping the economy, controlling inflation and managing demand. And what about government borrowing? Aren't we in debt because we borrow too much? Here's the truth. For currency issuing nations like the UK, bonds are not issued to get money to spend. They're issued to remove excess reserves from the system, to help control interest rates. It's a monetary operation, not household budgeting. And here's something most people miss. Commercial banks depend on the state to function. Why? Because all payment transfers between banks, whether it's your salary or your mortgage, settle in central bank reserves. Without access to these reserves, banks can't move money between each other. In other words, there would be no payment system without the state. Banks are plugged into public infrastructure every day, and the Bank of England ensures there are adequate reserves in the system. And yet politicians still repeat myths. Margaret Thatcher once said, "The government has no money of its own." But that's just not true. The government is the currency issuer. It is the only entity that can create pounds sterling, and the entity which licenses banks to create money in the form of credit. Without the state, there would be no pounds, no reserves, and no banking system. So let's recap. Where does money come from? It's created when banks lend. It's created when governments spend. And it's removed when we pay back debt or pay taxes. This isn't fringe thinking. This is how money works today. Understanding it helps us see the economy as a system of design and choices, not scarcity and fear. Understanding money is the first step to understanding power.